And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. If there ever was a year active management should have outperformed passive index strategies, 2020 and 2021 should have been it. Yet a recent report from Morningstar indicates that active managers in the last year did not outperform their passive peers compared to other years. Here to discuss, the author of that report, Ben Johnson, Director of Global ETF Research at Morningstar, along with Ed Rosenberg. He's the head of ETFs for American Century Investments, and Jerome Schneider is the head of short and low duration portfolio strategies at PIMCO. Ben, I read your report carefully. Only 47% of all active managers outperformed their benchmarks in the year ending in June. The performance is really a lot worse over longer periods. We'll discuss that later. Summarize why active managers can't outperform.
Well, it boils down to a few things, Bob, and one of those things really is survivorship. What we see is that over longer periods of time, most active funds simply fail to survive. They don't make it from the beginning of the period to the end. And why do they fail to survive? And in most cases, they fail to deliver the goods. They fail to outperform their benchmarks. And that's in no small part because they have a very high hurdle, and that hurdle is oftentimes their fees. They're oftentimes their own worst enemies to the extent that they overcharge relative to what they're actually able to deliver for investors.
Yeah, survivorship is very important, and it's one of the things you guys have always been on top of, and I think it's important. A lot of funds are just terrible, and they close, and people don't account for that. You do. By the way, love the guitars behind you. Very rock and roll there, Ben. Ed, you oversee several actively managed equity ETFs for American Century and for in general, and they've outperformed this year. Now, given the odds, how do you do it? How do you stick to your knitting and outperform, given the odds that Ben was describing there?
I mean, I think it's a few things, Bob. The portfolio managers stick to what they're good at, right? And we have three different types of active. So we have fundamental, which is a bottom-up approach. And then we have another approach, which is we'll call it fundamental. It's combining, or quantamental, I should say, combining quantitative with a fundamental approach, meaning a little bit different. And then we have more of a systematic approach. And each one of those managers have defined how they operate to stay within their bands, meaning do what they do well, focus on the stocks that fit what they're trying to do, and search for outperformance within that area. And the other thing, truthfully, is you guys mentioned it earlier with Ben, is fees are important. And the fees you charge are really important for those products. And if you look at the products we have, the fees are pretty reasonable for the active management that you're getting, especially compared to other products or even mutual funds in the space.
Yeah, we'll get back to low fees in a minute, and you're right. That is absolutely key. Now, Ben, equity managers aren't beating indexes, but it was intriguing in your report. Bond fund managers seem to be doing a little bit better. So active managers in the intermediate core bond space, sort of a broadest space possible, did well. 84% beat their benchmarks. That was impressive to me, although I see over a 10-year period it slips down to 27%. Why did active bond management do well in the last year, Ben? And then I want to get to Jerome.
Well, it speaks to the fact that active bond fund managers, unlike their stock picking peers, have generally over longer periods of time been able to add an increment of value by making out of benchmark bets. And what we saw in that 1 year look back that you mentioned, Bob, is that the overwhelming majority of active managers in the intermediate core bond Morningstar category beat their average passive peer precisely because they took on more credit risk relative to the average index mutual fund or ETF in their category. So they can color outside the lines in a way that index funds by definition can't. They can be more opportunistic, and they can reap rewards from coloring outside the lines and being more opportunistic, as many did in this most recent episode we saw in the markets.
So, Jerome, is that what you did? Now, you run the PIMCO Enhanced Short Maturity Active ETF. Mint is the symbol. That's, I believe, it's the second biggest actively managed bond ETF in the world. You outperformed as well. What's the difference between active versus passive bond funds? We talked earlier. You were saying there's thousands of stocks you could choose from, but there's millions of bonds to choose from. Does that give you flexibility?
I think the flexibility is important, and you're right to highlight that. ETF isn't spelled PASSIVE any longer. I think that flexibility, especially in bond funds, bond ETFs, allows for not only coloring inside the lines, but also not being forced to color at all. And so I think one of the things that Ben's report highlights is actually really important, that active ETFs actually allow for a degree of flexibility, perhaps taking additional credit risk, but it's also, as the landscape changes, which we are in an age of transformation right now, we need to be able to adapt and not necessarily picking to color outside the lines, but also picking to color maybe a little bit less within the lines, within the index. And that's really what is going to be the deciding factor about thinking about performance, not only the beta, but also the alpha, the ability to differentiate between indexes, and more importantly, the risks that the indexes might pose in the current economic environment. And I think that's one of the critical facets between active equities and active fixed income, which needs to be digested fully by investors. And so as we move to a more expansive universe of fixed income ETFs, that active approach will be an incredibly large differentiator, as been highlighted in his report. I think one.
I want to get this point across. Did you take more credit risk than your passive peers? Is that why you outperformed? I mean, just tell us what exactly happened here, because it's not obvious. You can do anything you want, essentially. You could go to cash. So.
No, I mean, that is fair. But what we seek to do is build a diversified portfolio. And having the resources to run the gamut of different types of asset classes, not just corporate credit, but look at structured products, maybe have a little bit more cash. Think about where an interest rate curve might be more sensitive and be more advantageous to clients. That's really the facet which hasn't been fully optimized or optimized at all within the passive universe of ETFs for a very long time. And so in the past, while the Fed was in its new normal policy measures, being very vigilant, low volatility, and providing a very balanced view of where credit spreads and risk appetite was, that was fine. You could possibly take more credit risk, whether it's in corporate credit or structured products. But now that we are evolving to this age of transformation, it actually is critically important to create differentiation within the product and not necessarily embed or be wedded to a growing aspect of the beta risk in the index that might actually prove very harmful to investors. And so just one thing to point out, back in 2008, the composition within the Barclays aggregate, the fixed income aggregate index, was about 8% for triple Bs. Now it's north of 15%. So simply by owning the index, you're owning a lot more credit risk, which may not necessarily be the right positioning to have in this current environment where we sit here today with growth moderating and a variety of central bank policies creating the propensity for a little bit more volatility in the future.
Okay. Now, Ben, I want to go back to why active managers underperform, because this is a teaching moment for those of us who've been watching this. We've known about this for decades. You've been covering this for many, many years. And I'm wondering how you account for the persistence of active management. There's 3 points the report seems to make here. First is that the concept of market timing doesn't really work. It's hard to be right going in and going out. High fees and commissions erode alpha. That seems to be the second point here. And third, I hear this from my old buddy Larry Swedrow all the time. More professionals are competing against other professionals. It's just harder because there's just fewer individuals in the market and more professionals to compete against. So sort of sum up this for us. How do you account for the persistence of active management? Are they selling us something that we want to believe but isn't really true? I mean, riff on this for a minute.
Yeah, well, I mean, we've talked about fees already, Bob, so that's really foundational. I think the other point that Larry rightly picked up on is just the dynamic of the market itself. It's not that these managers, these portfolio managers, there's teams of analysts aren't incredibly bright, skilled, uber intelligent, well-equipped. They're as bright, skilled, intelligent, as well-equipped as they've ever been. So we've moved long past the days of Harlem Globetrotters versus Washington Generals, where professionals could pick on a large contingent of individual retail traders and get out ahead of them and outsmart them. It's now kind of Harlem Globetrotters versus Harlem Globetrotters, NBA All-Star game, whatever you want to call it. This isn't, LeBron versus me in a pickup game. This is LeBron versus himself. So the level of skill that you see, especially in the U.S. market, is as high as it's ever been. It's as hotly competitive as it's ever been. So it's harder than ever to eke out alpha. And if you want to look at a contrast there, my colleagues in China actually have done a similar analysis of the Chinese funds market, where there's a huge active retail investor base. And what you see is that 90+% of actively managed mutual funds in China manage to beat their indexed peers. So I think this is one proof point of one of the most fundamental factors that drives what we see in this analysis.
Yeah, Swedler likes to say the pool of victims is shrinking in the U.S., meaning retail investors who are not as sophisticated. We'll get to that in a minute here. But Ed, you're a guy. You oversee several actively managed ETF. Let me look at some of your holdings here. You run the Advantis U.S. Equity ETF, AVUS. Yeah. Now, explain how you pick stocks. I'm looking at this, and again, this looks mostly like high-quality tech and pharma here. Apple, Microsoft, Amazon, Facebook, Alphabet, Johnson & Johnson. I see these in a lot of funds these days, but what's the criteria you use for picking funds?
So think of, for AVUS, for example, think of it more as a modern approach to active management, where it's combining what you get from indexes, which is diversification and low fees. But instead of relying on the index or waiting for a rebalance period, which may be monthly, quarterly, semi-annually, or even annually, the portfolio managers are looking at it every day to account for the things they want to account for, right? So they're not just looking for the things you would normally look at market cap. They're also looking at balance sheet and profitability, and you're combining what goes with an index along with an active management in what you could call a best of both worlds for that situation. And so with something like AVUS, you get the full diversification, and you get it at a pretty reasonable price at 15 basis points. So that's why you would say that it goes back to the fee discussion that we just talked about. And it also is combining different things that make it attractive to both index and active users.
Yeah, and we're putting up the Advantage small cap value. That's done well this year, but small caps have done fairly well. And, we know historically, not to get into, academic studies like, from a French two-factor, we know that small cap and value, two factors, do tend to outperform over time, although they have not in many, many years. So you're sort of in that sweet spot this year where some parts of the year, small cap and value have done very, very well. Do you still, I'm asking a generic question, Ed, but do you still believe in the concept of small cap and value as factors that will long-term outperform?
I mean, I do, and let's add into that what the portfolio managers also account for. They also account for balance sheet, profitability as well. So it's not just that tilt towards small cap and value, which I think over the long term can outperform. And you'll see periods of underperformance with that, but if you hold it for a long period of time, it will outperform. But when you start adding in other metrics like a profitability or looking at the balance sheet and taking into account what makes a company a good company, it actually gives you more of an advantage as well, right? Yeah. Over time, you should be able to outperform by even more. And if that graphic of AVUV, I'm sure in the last year has shown huge outperformance.
The problem, Ed, is over time, small cap might outperform big cap. And you might see other little outperformances elsewhere, but it may take a long time. And the small cap people and the value people have been waiting many years for a little bit of outperformance. Jerome, I want to turn to you. Active bond funds did well in lower volatility as well. You're the bond fund guy. While I've got you here, give us your take on where interest rates are going today.
Yeah, absolutely. Interest rates are obviously been in flummox really over the past week, especially front-end rates at this point in time. The digestion and trying to figure out exactly where the landing point is for inflation is obviously front and center, not just here in the United States, but globally. Supply chain constraints, labor economics, things like this, the employment cost index from last week. These are all factors which are ultimately going to figure out and really come into construct of how the term premium plays out. So long story short is we are probably in for a period more immediately of a little bit higher inflation, which will effectively moderate as we get into 2022. And it's going to create a little bit of tension, especially for the Federal Reserve, who's going to have to be a little bit more patient as the digestion for inflation actually occurs, and we see some of these supply hindrances come back online and alleviate some of this effect. I think one of the key points, though, here, Bob, is really this. When you think about where we've come from, in fact, where we've come from, what we used to call the new normal, doesn't really apply anymore. And I think that era of low rates and low volatility is gone by the wayside. Now, when we get into this area of a more new neutral policy, that effectively means that the cycles are a little bit shorter. The amplitudes of the cycles are probably a little bit more severe, higher and lower. And as a result, when we think about the response function is probably going to be a little bit more passive, patient from the Federal Reserve, especially if they see spikes a little bit beyond their comfort level for inflation. So ultimately, when they bring that inflation back in closer to that 2% PCE, which is well above higher at this point in time, then they're going to actually find a little bit more runway, not necessarily to be in that rate hiking sequence at all. So our forecast for rate hikes is probably still 2023, maybe pushed very into late 2022. But right now, we think that inflation begins to moderate, and that will give the Fed a little bit more leniency in terms of how they respond to the current
over
conditions.
the weekend, everybody was talking about Goldman Sachs' call about maybe rates starting to hike in July of 2022. Doesn't that seem a little early to you? I know this is Goldman making the call, but you know, it seems like an aggressive call to me.
Well, it seems aggressive, but frankly, that's where the market's pricing right now. And you look at, you basically have a 44% chance of probability of a hike in June, and you probably have 2 hikes priced in fully for the 2022. So the market is actually there into that construct. So I wouldn't say it's necessarily off the market. It's probably more consensus if you want to actually look at the market. I think what is important, though, is understanding how the digestion actually occurs. So you have to take a view on, is the inflation that we're seeing actually getting baked into the psychology, into the framework, into the long-term inflationary expectations of the investor. If you don't believe so, and the Fed doesn't at this point in time, but we'll find out more later this week, then you're going to actually see that those rates rise potentially if that inflation gets carried away. If it doesn't, then you're going to see a Fed being more patient, not necessarily hiking twice in 2022. That's the tension right now.
All right. So, sorry to get a little wonky, folks, but I got a bond guy here, so I got to, hit him up on this. I want to get back to the active versus passive debate, and anybody can jump in here. It seems like passive is winning the inflow game, no matter what you say. We've had, I think, $700 billion in inflows this year into ETFs. We've got a record year. I put up the numbers here. Most of it is passive still. Active is still a very small part of the inflows. Even with mutual fund conversions we keep hearing about. Is there any reason to think that this is going to change? Ed, you and I were talking about this earlier, just massive inflows into passive funds again this year.
Yeah, and let's start off with there's a lot of ETF models out there to start with that own passive. And active, while it's been around since 2008 in the ETF landscape, has been slow to adopt, especially on the equity side. I mean, 2 years ago, almost 2 years ago, at the end of 2019, the active space was only 100 billion. I mean, sounds like a lot, but when you compare it to the overall ETF space, it was a really small percentage. The end of last year, it grew to 174 billion. And the equity space was the first time it really grew. It was only 15% at 19, and then it grew significantly to about almost doubled, around 30%. But the issue you have, Bob, is a lot of these funds are new in the active space with the advent of different structures like not being able to show your holdings every day, or what we call semi-transparent. It's really been more ETFs have been coming to market. And this year alone, there have been more active ETF launches than passive. So I think you're beginning to see a lot more active come in. And I think time will tell if they can supplant some of the passive. But because they're ETFs, a lot of the ETFs have a lower fee structure than mutual funds, traditional mutual funds, because they're new products. And so having that lower fee structure can attract more to take a chance.
So, Ben, is that going to make a difference? I mean, if active doesn't outperform passive in a mutual fund space, is it possible it could do better in an ETF space if the fees are lower?
Well, absolutely. Incrementally better, Bob, to the extent that the fees are lower, first and foremost, and to the extent that the ETF wrapper might mean that those strategies are delivered in a way that's more tax efficient to the end investor who's investing taxable money in that particular strategy in a taxable account. Now, while those two things may reduce the force of gravity on active strategies, I should stress that they are not a pair of anti-gravity boots, and none of these things is a given. So we can know to an extent with certainty that the fees might be lower. What we've seen to date is actually kind of a mixed bag with respect to tax efficiency when we look at the same strategy as it's been delivered through an ETF versus an open-ended mutual fund. And a lot of that has to do with the fact that we haven't seen a lot of sort of two-way flow into these ETFs, and outflows in particular, which are critical for purging low-cost tax lots and getting that uptick in tax efficiency relative to what you might get from a mutual fund. So again, a gravity reducer, but we're not talking about a pair of anti-gravity boots when we take an active strategy and convert it to an ETF, replicate it in ETF, you name it. The ETF has undeniable benefits for the end investor, but they don't cure everything.
Yeah, I think that's a good point. All right, everybody, I'm going to have to leave it there. Fascinating discussion. That's it for this week's ETF Edge, and my thanks, of course, to Ben, Ed, and Jerome. I've asked Ben to stick around. We'll talk a little bit more about active versus passive for the ETF Edge podcast. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.